Hello, everyone. Welcome to the weekly roundup. Today we will cover geopolitical risks, monetary policy, and market sentiment. Hello, Ben.
Hey, Eva.
How's it going?
Good. It looks like when I look in my camera here, it looks sunny outside, but that's not true.
No, it's not true.
It's very dark out.
It's a rainy day,
Yeah, it is.
and you wonder where's summer.
Uh, well, last night it was super hot, like mid 30s, still at 6, 7 p.m.
Okay, I'm not complaining though because 30 degrees is ridiculous.
Yeah,
So this is fine. Let's get
yes.
some cool. Okay, we're gonna be starting off with geopolitics. Trump has essentially declared the ceasefire over.
Yep.
What does this renewed uncertainty mean for oil prices, for inflation, and I mean overall market sentiment?
Yeah, so I think that's a good place to start. And we what we shared there and the daily was just to look at what was going on with oil prices. And you know given what has happened that way, I would have thought we would seen a bigger spike in oil, and a bigger kind of inflation risk jump up. And so I guess so far, I think it's more of the same. And as I read through a lot of the commentary going on, it seems like they're probably not going to come to a simple, easy agreement, ceasefire agreement. Doesn't look like Israel and Lebanon are coming to a ceasefire agreement either. So I think the world and the markets just have to be prepared for more uncertainty. And so I think that's resulted in a lot of chaos in the markets. And it's a really strange environment, but anytime there's a risk that supply chains get disrupted again, there's a risk of higher inflation, but then that has knock-on effects to the economy, slows the economy faster. And so I think there's a lot of moving parts, and the market's a little more fragile than it's been in a long time.
Yeah. So the Fed's next move is basically still up in the air.
Yeah.
What economic data should investors be watching most closely over the next few weeks, and what could essentially shift the Fed's thinking right now?
So I think we're still in the early days with Warsh to find out what he's going to do. But I think following CPI or core inflation numbers are going to be important to pay attention to see what's going on there. Because core inflation seems like it's within bands right now, even though there's a slightly hotter print. It wasn't anything like the coming out of COVID numbers where we're seeing inflation run away or anything along those lines. So obviously continue to watch that. Watch the forward rates of interest rates in the markets because you're starting to see rates pricing a little higher, which actually surprises me given all the uncertainty in the economies. But Warsh is going to be important to watch because effectively he's petitioned on cutting rates. But in the first meeting, it sounded like he was towing the line around status quo. We're going to continue to do what Powell was doing. He didn't say that in so many words, but that's really what the message was coming out of that. So his next meeting, I think, is going to be really important with the view of what's he going to do. One of the things that he talked about doing for years is getting rid of forward guidance. So I'd say that would be a key piece that I'd be watching, and that would provide quite significant disruption to the market if they start changing their view on forward guidance. But yeah, I would think there's a low probability of anything happening in the next upcoming meeting, but I'm hopeful that we get more context and clarity around his thinking and strategy from here.
Okay. So my last question is basically around the markets. We are well into Q3,
Yep.
and Q3 has historically been the weakest quarter for markets.
Yep.
Should investors be taking a more defensive approach, or are there opportunities in the volatility?
Yeah, I'd say yes to both.
Good.
Yeah, I'd say yes to both because if we look, yeah, it's one of the things where the last decade, there's been this thinking that there's no other alternative that you have to own stocks. But we're seeing across the board, like the 30-year Japanese bonds at 4%, 30-year US at just over 5% here, 505. Australian long duration bonds are kind of 5.5. And so you're seeing high quality government bonds that are north of 5%. Yes, there's this argument of, is it going to protect my capital with inflation erosion and so on and so forth? But from as long as I can remember, at least 15 years anyways, you couldn't look out into the future and buy really high quality bonds north of 5%. And so the answer is, yeah, I think there's an opportunity for some defensiveness where you can buy bonds that are actually yielding something so that if there is a correction into, we'll say, equity or risk assets, that you got a reasonable amount of ballast or protection. So the answer is yes, you can do some defense, take some profits on things that have done well for you, maybe the financials in Canada and some of the tech names in the US if you participate in either of those places. But still, from a perspective of tactical, what can you do? What's going on in that space? We've looked at a lot of things, but some of the more out of favor names, like we mentioned, I think a couple of weeks ago, is Netflix. Some of the Canadian companies like WSP, which is a big engineering firm in Canada, is touching plus or minus its 52-week low and just been trending lower. So there are some opportunities where these kind of unloved names can add some good long-term growth, but at the same time, be able to pick up some high-quality bonds that I think can protect the portfolios if there is, a September, October kind of chaos that we've seen in the past.
Let's do the charts.
All right, just
Well, Ben, I think Ben's frozen up there. Okay, I'm gonna try to get Ben back up here. Uh, Give us a few moments, please. Thank you.
hey,
Okay, there you are.
we're back.
Yes, you're back.
My favorite thing is that teams like to upgrade during our presentation.
Absolutely. Okay. Oh, I think we lost him again. Uh, I'm gonna try to bring him back up.
Hello.
Hello.
I think I should just get going before it happens again,
Okay,
which is
go for
definitely
it.
possible. Let me know when we're good.
I think we're good.
Okay, awesome. All right, so we're recording this around 1:11 on July 9th, July 9th. Time's going fast. Okay, we'll start off with the speculative positioning for non-commercial CFTC. So this is futures and options. I love this report from a perspective as it gives a pretty good cross-section of the different areas, equities, rates, FX, commodities. Give us a better sense of what's going on from a positioning perspective. Are we overweight one thing or the other? And from my view, as I look across the different areas, the areas that probably look the most attractive or the most interesting from the point of uh, what's positioned the most negatively or positively. The one thing that I'd look at is the US dollar is position kind of neutral to bearish. So that's an interesting point of view given what's going on in the world. The other positioning there is sterling US dollar. Again, sterling looks pretty negatively positioned. So I'd say across the currency perspective, there's some areas there that could look attractive. The last one, which we haven't talked about too much, was kind of this reverse carry trade that's been happening, where a lot of institutions used to borrow money in yen, convert it to US dollars, and reinvest it. Now we see money going back, and the yen's been getting beat up, and the yields have been rising in Japan. And so yen is as low as it's been in an extremely long time. And then vice versa to that, when you're looking at rebalancing from that point of view, even where you asked before is, do we want to get a little bit more defensive? In a contrarian view would be potentially Japanese bonds with Japanese yen exposure, because those two things could offer a huge risk reward if that does turn in the favor of yen and yields falling in Japan. The market's not positioned for that as well. So that's why I look at this chart to see from a positioning point of view, is there something I'd like to do if you add a 1 or 2% position that the market's not expecting, that could add some really good alpha to the portfolio. So love this chart looking across the different areas, equities, rates, FX, and commodities. Next one is expected 1 year total return from a change in interest rates. And so I've had so many conversations over the years about this, but I think it's an important one because often we think when we buy bonds with the coupon and we hold them to maturity, and that's the only reason why you own them. And so this does come back a little bit to your question around, if we want to be a bit more defensive, what we'd be looking to do. And so there's still long-term view that, potentially you want a 60/40 or 50/50 portfolio, say 50% stocks, 50% bonds. Well, what you own within those sleeves can have a big impact on how that's going to play out within the portfolio. And so if we look at where we are today, as I mentioned off the top, if you're looking at buying a 30-year US government bond today, you get 5% and your principal guaranteed. So 5% for life, you would get your coupon, not everything else is equal. But in an event where rates come down in the US, which is this way, so if rates went from a 4% value, or sorry, 5% value to a 4%, so rates fall, that means prices go up in that backdrop. So that bond you buy goes from $100 to $120, effectively a 20% capital gain within that part of your portfolio. If the inverse happens and we go from 5 to 6%, which is generally, if you read the news and headlines, everyone says rates are going up forever. So the market is obviously pricing for this, which is a same 1% in the other direction move, you get a minus 11%. So when you look at it, from my view, maybe it makes sense to have some duration where the risk is tilted towards the one thing happening, which is rates going up. So you get a 2-for-1 balance. You can have some protection if the opposite happens. So that's on the 30-year US. Then if we look at Canada, for example, which if you don't like that type of risk reward, but you want to have some stability and you want to play a little bit of defense because markets have done well. So you can look at just for example, here, the Canada Corporate Universe. So you can buy either individual corps, so you can buy an ETF or a fund. We look at both funds and ETFs in this category. You can get paid 4.1%, which is pretty good. If rates go from 4.1 to 3.1, you get a 10% capital appreciation in that portion of your portfolio. If rates go from 4.1 to 5.1, which some people may think is a risk, you could lose a little bit of your principal. But the reason why this is great to look at and why when people say you should only own stocks versus bonds aren't even in the same category. If you buy a stock can go down 50% tomorrow because they miss earnings, CEO moves on, so many other variables, where a bond trades completely different to that backdrop. And so I love to look at this chart, and it's an important piece around thinking around portfolio composition and why you'd own certain bonds to do certain things within a portfolio. And the last one, this is for Canada. And so, Eva, you asked off the top just around what do we watch and what do we pay attention to? Obviously, lots of things I talk about are centered around the US. Tried to put this last slide in just around what's happening in Canada and the Canadian market, and the things that I think we need to think about from a Canada point of view is there's two pieces here. So this is Canadian inflation on the left, and this is the Canada National Bank Home Price Index. And so the Home Price Index, while it may seem like it doesn't mean a lot from a point of view of how it's going to play out in the economy, we look at this gray bar. So this is the Canada Composite Index. So we're in the negative category. Montreal is the blue line, and so still in a slight positive. Vancouver actually quite negative. Toronto quite negative. And so there's been a lot of pressure on housing prices. Some of it's been in interest rate related. I think it's more so been in a slowdown in the Canadian economy, a slowdown in the jobs numbers in Canada. And so I think this is going to be a key piece to what happens to the Canadian economy and what happens to interest rates in the short term. So we watch this coupled with what's happening in inflation. And so, as I mentioned, we look at core, I think will be the key one to look at. So this is average core CPI, so Consumer Price Index, which is still 2.1, so that's still falling, but total CPI has jumped, and that's something that the central bank will pay attention to. But core staying in this range, I think, keeps them on hold, at least for the near term, and we'll have to continue to watch and see if inflation picks up, core inflation picks up. But my view is nothing happens to Canadian interest rates, at least in the next 3 to 6 months. So that's it for today. But as always, the opinions expressed do not necessarily reflect those of National Bank Financial. Everyone has their own risk tolerances, and if there's anything in here that you think's interesting, want to talk to Eva or I, please reach out. Happy to have a discussion, see if it's appropriate for your risk tolerance.
Thank you, Ben.
Charts, no problem.
Finally worked.
Made it happen. Tried to go fast.
Good. What's on the agenda for next week?
So we have the Canadian Central Bank next week, so they have their meeting on Wednesday next week, so I'll be watching that. Again, I don't think there's anything that we need to be worried about from a rates up, rates down perspective, but more on a view of what's going to happen in the future. What do we see happening? What does the central bank see, and what do they expect from here? So obviously, most important is to watch their notes or watch and listen to what they're saying, read their notes, any updates that they saw last month. But I think kind of the biggest view for me with we'll say the ceasefire's over, is the market reacted in mostly a ho-hum. Oil didn't take off. It did go up a little bit. Gold didn't take off. The market sold off again marginally, just on the seams, nothing material. But we are into the summer months, and August has, at least historically from my recollection, can be much more thinly traded and can result in some air pockets in the market. So we'll be watching that. But from a big picture macro perspective, interest rates in Canada will be the important one to watch.
Great. Thank you, Ben. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box if you're subscribed. For our clients, please reach out to me if you have any questions. or if you'd like to book a portfolio review meeting with Ben. Thank you for listening and enjoy the rest of your week.
Thanks,
Bye.
everybody. Bye.